Alright guys, welcome back to another video. In this one, we're going to be going through how you can make consistent returns using stocks, having stocks pay you just to hold them or even to just buy them. This is going to be an extension of my last video that I made. We got some awesome feedback and it makes me really happy that I get to make this video going more into depth on this strategy and how easy this is to make a couple percent every single month on a live account. The comments from the last video were awesome. You guys are wanting to learn more about this, and whoever's new watching this is not get rich quick strategy. This is if you want consistent returns and trade like a pro trader, stick around for this one. So this video is going to be more of a continuation of the last one, but one of the biggest reasons I like this approach is so simple. It's more consistent and it's far less time consuming than my active trading. I'm not glued to charts. I'm not guessing every single one of these candles. I'm not forcing trades every single day. Instead, I'm structuring positions where I already know the price I want to own a stock at, the risk that I'm okay with, and what happens next. So in this video specifically, I want to show you how you can start building capital with cash secured puts with as little as even $3,000 in an account, and how this fits into long-term wealth and not so much get rich quick in trading. So the reality of this, and let's be very clear about the limitation here, when you're starting with say $3,000, the most expensive stock you can realistically trade is about $30 per share. You have to remember that options control 100 shares of stock at any given point when we're talking about cash secured puts or covered calls. That means if you have a $30 share price times 100 shares, that is $3,000. So basically, if you're starting with $3,000, your entire account is going to be tied up into one position. There's no diversification at the beginning. There's no spreading risk across 5 different stocks. It's one position at a time. It's not exactly a flaw. It's just the reality that you're going to have to get used to early on. And this is how most people have to start until their account grows. So what is a cash secured put? Let's recap this before we jump into talking about them in depth. A cash secured put is basically just a paid limit order. The easiest way to understand a cash secured put is it's basically a limit order that will pay you. Instead of placing a buy order at market execution and waiting for free, you agree to buy a stock at a lower price, set aside cash to do it, and get paid up front for that agreement. That's it. There's no leverage. There's no guessing. It's just structure. And one more time, let's go over in the money versus out of the money. When you hear OTM or ITM, here's all it means. If my strike price was right here at $25.25, if I'm talking about out of the money with a cash secured put, that means the stock is trading above my price, which means we are waiting here. If I'm talking about ITM or in the money, that means the stock is trading below the price that you agreed to, being right here. Assignment just means you're buying the stock at the price you agreed to, which is here. It could drop all the way down to here in 10 seconds, but you will still be assigned at the price that you selected. If that scares you, you're not using this strategy correctly. Assignment is not failure. It is part of the plan here. So there are 2 ways that I run cash secured puts. I don't run them the same way at the same time or all the time. I rotate between 2 approaches. So one thing you have to remember in options specifically is time means everything. When you choose to pick an option that is further out in length than closer in length, you have more room to actually have more relaxed cash secured puts that have more time and strikes are farther away from current price. But if you're doing, say, weekly cash secured puts, your strike price is going to be a lot lower to the current price. So if we hop over to Interactive Brokers, we can actually see how this works. So right now, if we're looking at SoFi, which is a stock trading at $26.56 currently, meaning if you bought it at the current price that it's at, you would have to set aside $2,656 to own that. With a cash secured put, you're obviously selling at a lower price. So say that we got it at around $25. You are setting aside 100 shares of that stock at $25, meaning that is $2,500. So if we hop over to Interactive Brokers on this, we can actually see what we would be getting with a $25 strike price. Right here, we would be getting $0.05 per share at this strike price. All that means is the simple rule of thumb is move the decimal place over twice, meaning because 100 shares. So we would get paid $5 to hold this stock for 1 day by putting aside $2,500. $5 is not that great. I understand that that's probably completely not what you guys are looking for here, but look what happens if we go 22 days out. So around 3 weeks out at the same strike price. Now, all of a sudden, that $5 turns into $67. No complex math here because it's 100 shares, 0.67 times 100, just move the decimal place over twice, $67. So you're tying up $2,500 to make $67. So let's do some quick math here. If we have a $25 strike price and we have a 66-cent premium per share and we have 100 shares, that means we gain $66 on the $2,500. That is over 2.5% of gains just for holding this for 3 weeks. 2.5%. You guys imagine what that would do in an actual trading account? That would be huge. And when I talk about this stuff, I always talk in terms of percent. The money doesn't really matter if you're locking in the percent gains that you require to actually make a significant difference in your trading account. And this is why I say it's such a consistent strategy, because you're just agreeing to buy a stock at a price that you like and getting paid up front. And again, going back, where is $25 on the chart? That's right here on the chart. So we are currently, how far are we? We are currently 6.2% away from the current strike price. So we're assuming that stocks obviously just continue to the upside, as we naturally do and as you would hope. But the difference is this stock would have to come down 6.2% just to tag you in. And you're getting the stock at a price you already want. I would love to own SoFi at $25 because the upside of it is huge. I probably wouldn't even sell a covered call until we were super far in the money because of the return that I would get on the shares itself first. So this is how time can work to your advantage here. If you're playing within, say, a week, if we go back to that same $25 strike price, you're getting $22 for those 100 shares. So it's a lot different, but you can run this back every single week. So those are the two ways you can run it. I don't run them the same way. I just rotate between the two approaches. With monthly, you have more time and strikes farther away from price and a bigger buffer. I like to use this when markets are choppy. I'm already ahead on the month and I want less stress. Weekly cash secured puts are more aggressive. There's a shorter duration, the strikes are a lot closer, and the premium is a lot faster. If the market conditions are clear and comfortable, I may target 0.7 to over 1% per week. More reward, but less room for error. So the rule of thumb here is longer time means more forgiveness. Shorter time, you need more precision. So in a case like this, we might have a strike price all the way down here versus having a strike price right here. The premiums here are better, but this gives you a bigger buffer on your account. So it is one of those things where you guys should be paying attention to the stock. You should be paying attention to your personal risk tolerance and what you think the stock will be doing. So there's a lot more research that goes into this on the current stock that you like before actually getting to the point of selling your cash secured put in the first place. So a quick scenario of this would be if I'm 2 weeks into the month of December and I'm already up 4%, there's no need for me to get greedy and start targeting aggressive strikes on SoFi being like right here or right here. I would probably sell a cash secured put down at $23, lock in a couple more percent to bring me say to 5 to 5.5% over the remaining 2 weeks of the month instead of going hyper aggressive and putting my strike price right here where we do risk getting assigned. I would like to see a break above the EMA showing that we're going bullish and back to the upside. So for now, it totally does depend. If you want to own SoFi a lot lower, you can do that if that's the way you're playing. I do play some stocks specifically where I do think we're going to have a big drop. Right now, if we take a look at Apple, you can see Apple had a bit of a sell-off here. I would love to have owned Apple down here at 267. So you can use a cash secured put as almost a limit order, like I said, getting paid to do so, because as soon as you picked it up, say around 267, look at the upside that we're having now. It's Apple. This company is going to be around the next 10 years. Yes, you have to set aside $27,000 to do this, but this all comes with a scaling game. So what happens once I own the shares? You can sell covered calls, meaning you already own 100 shares and you're selling the right to buy them at a higher price. So I ran through this in the last video, but we'll recap it over here. So say we had chosen this support zone right here at $25.25. SoFi comes down to $25.25 and assigns us at $25.25. So now what we're doing is we're waiting for the stock to come back to the upside. And in doing so, we're selling a covered call. And with this in mind, if the stock stays below this price, you're still keeping the premium from the covered call and the cash secured put and just waiting to get back to the highs. If it reaches the highs, say that we set it at 28.57, that means we sell the shares at this agreed upon price. And if we go back to Interactive Brokers, this is out of delay, so obviously these premiums don't match exactly right now, but you can see that we are kind of close to that support line right here. We're actually right on it from earlier this morning. So assuming that we were selling a cash secured put at the 25.25 mark, we would have been assigned right here. And look what would happen if we wanted to sell a covered call at 28.57. So then we head over to IBKR and we can see that we would be paid $17 in premiums for selling it at 28.5. So we see here 28.57. Yes, it's a little bit off, but it just has to expire there to get us called away. So this is with an 8-day expiration. So basically, you're getting paid $17 for that week just for making the promise to sell your shares. So not to mention, if we go back, we can see that from the $25 holding all the way till the 28.57 mark, you're making a 13% gain on the stock itself plus the $17. So let me clear my screen and we can run an example of this. So say SoFi is trading at $27 and we say we'll sell a cash secured put at $25. SoFi comes down and assigns you at $25. But for selling the cash secured put, you made 2.5% on the stock. Now, what you're going to do is sell a covered call, and say we're using the 28.8 line right here, resistance level, as our covered call where we're selling from. So what we're going to do is check IBKR. Let's pretend we're 8 days out, and we'll use the $29 one because it's right above there. So if we use the $29 strike price, we're making $11 just to promise to sell our shares. And that would make us another 0.4% just for making that promise. So now we're making 0.4% on this right now. And if the stock continues climbing all the way up to this point where we sell from, if our assignment is up from down here and we choose to sell right here, that is a 13.84% gain. So now we have the 2.5 plus the 0.44 plus the 13.84. So this happens over the course of a month, which it usually does with how I play stocks. You just made 16.78, mind my 7 here. You made 16.78% on your $2,500, which roughly equates to $400. So even with a balance of $3,000, you can still make $400 if you pick the right stock and it plays out in your favor. So now all months are not like this. This is just a great example of something that can happen and that has happened to me multiple times. But I wanted to show you the power of this because once you guys actually understand that you're making a minimum percent off these premiums, and God forbid you do get assigned and you're targeting the right zones, you can actually play this and yield a lot more on that monthly percent. Even if this played out over the course of 3 months, you're averaging over 3% per month for this one position. And this is the realistic returns of compounding. Most professional traders aim for roughly 2 to 3% per month over time. Professionals, the S&P averages around 10% for the year. So when people promise 10% per month consistently, that is not realistic. And with cash secured puts of what I'm showing you, even a 3 to 4% per month done responsibly is a ridiculous amount of gains. You're pumping up over 30 to 40% per year if you are consistent with this. And this goes even crazier when you start compounding and add capital. The goal here is not speed, it's your durability. So now risk management when starting small literally determines your survival. So with a stock like this, yes, I personally love it. Do your own research 100%. None of this is financial advice, just a recommendation. But if you sold a cash secured put from these highs around this resistance level, currently you would be down 14% on these shares. I think most people would be freaking out if that happened to them because that would be their entire account. But in a case like with the wheel, you have to remember, if you do an analysis on a stock and know that this stock is going to do great things in the long run, I believe the analyst rating for SoFi is around $80 and we're trading at $26. So if I think we have room to the upside, why would I cut my losses when we're down here at the lows? If anything, you can even cost average your position even lower and then sell more covered calls on the way back up. So it is one of those things where you have to be dedicated to this game. You have to understand the risks, the inherent risks with this, and love the stock that you're playing it on. The next thing is obviously going to be don't chase your premiums. Right now we're trading at $26.50, which is right here. You can easily sell cash secured put and make $50 for holding for 8 days if it comes down to that price. You know what? That does sound really good, but at the same time, you have to remember that if you get assigned what to do in this situation, you're going to start running covered calls, but do you want to be assigned? So the biggest thing in this game is not chasing premiums. You can choose a horrible stock that has amazing premiums. You don't want the stock long term, but you see those juicy premiums that could even pay you, say, 10% just for holding it for a week. This is where I will say, do not chase the premiums. It is not worth it getting tied up in a stock that you don't actually like, and now you're stuck bag holding it, just praying that it goes back to its highs or your current strike prices. You have to accept your concentration very early on with playing with a small account, and your goal is protecting your capital first. Because if you are stuck bag holding in a stock, there is nothing worse than not knowing what to do when you're in a stock that you do not like. If you're stuck in, say, SoFi, for me, I wouldn't really mind that because I do think this is going to do great things. I'm currently down incredibly large on a stock called IREN, but I do believe in that stock very, very much, and I do think this is going to come back to the highs, and I do think it's going to do very great things in the future. So I don't mind being down a lot on the shares right now. The next thing is obviously going to be add money whenever possible. If this is a strategy that you are going to be doing for the long run, like I am, you do want to be adding money as you go on. I like to funnel a lot of my trading profits right into this account because it is better than just a regular savings account and money sitting in my bank account doing nothing. If you're ignoring any of these rules, cash secured puts will not save you. They will be the death of you and your account. So I do want to talk quickly about how this evolves as you grow. As your account grows, the strategy does get easier. You can start diversifying across multiple stocks, choose different sectors, reduce single stock risk, and eventually you're no longer stuck trading these cheap names. You can sell cash secured puts on larger, higher quality stocks that you actually really enjoy owning. And this is when it becomes more flexible and not so much restrictive. And I know I am very excited when I talk about this because this is a very exciting topic for me, but this is not exciting. It's not flashy, it's not viral, but it's very repeatable and it's very scalable, and it respects time in the markets, which is the king in this game. Cash secured puts and covered calls don't replace trading for me, they more so complement it. If you treat this as a long-term framework instead of a shortcut, it will become one of the most consistent ways to build wealth over time. Slow, boring, and effective. I'm gonna start making more videos on this because I love the feedback you guys had in the last video. But if you have any questions, please leave it in the comments below. And with that, we'll see you guys in the next one.